When we're determining, or when I'm specifically working on a bias, I like to build that idea ahead of the Sunday opening. But whatever time it is, it's usually about 30 minutes. It takes me about 30 minutes to go through all the major markets. And the first and foremost thing I'd like to look at is where we are in terms of seasonal tendencies. Okay. I look for the best period of time in the spring, and I look for the best period of time in the fall, because what I've done is I've cherry picked the very best of the best times to trade, because the spring season and the fall season, that's your turning points on the higher time frame, monthly and weekly and daily charts. Okay, because if you're going to be a long-term position trader, or you want to have a long-term bias, those turning points, they're like the bookends. Okay, they're the parameters for the big huge runs every single calendar year, are usually boxed in by the extreme high or low of those two time periods. Okay, so if you can focus on the spring and fall session and anticipate directional runs that last for weeks to months, it's not always a straight shot from a spring high to a fall low, but predominantly it is. And again, that's the part where you're supposed to write that down. So what happens if you are in a market environment that's bearish? Wow, you really have a loaded deal, because in spring, what is spring? April, May, okay, April and May, there's this transition that'll send the markets lower and going down into the late summer weeks or months into September or October, and as late as the first week of November. But very rarely does it do its turning point in November. Usually you'll see the turn between the last week of August and the second week of October, and that's usually the low of the year. That's not 100% always happening, but that is how I look at the market. Every single year I go in with expecting that to unfold. And then what I do is I look at the details that the market's actually showing me day by day, intraday, week by week. How are we behaving? How are we anticipating these targets? Are they still probable? Are we still likely to trade lower with that mindset? Now, what happens when you're in a very strong bull market condition, like we've been for several years now? That means that the spring highs can tend to be quick and sudden initially, and then it can go consolidated a little bit and then slowly drift down. Or because now it's a presidential election year in the US, those spring highs down the fall lows don't tend to be as crisp or pristine in price. It's a little bit muddied, and sometimes it can be altogether rejected, and there's just a short-term drop in the spring months. And then when we get to mid-May or first week of June, we take off and we start going higher. And we don't even try to do anything going into the lower extremes for the summer months and or making a low in the fall. There will be likely a low that forms in the fall. Any environment, whether it be a bearish market or a bullish market, it's just a very strong tendency for the market to create very easy long positions, opportunities to see the market rally. It may be short-lived, but trading in September, October, and the first 2 weeks of November, being a long holder, looking for longs, that is like some of the easiest stuff you'll ever do as a trader. So I like to look at those two extremes of the year. So that way we know now the highest form of determining bias. I gave it to you for the full year. How do we anticipate power 3, which is the accumulation, manipulation, distribution of price action on any given time frame? It's on every time frame. After looking at seasonal tendencies and looking for times when a market that I'm interested in trading has both the longer term and the intermediate term seasonal tendencies agreeing. And what does that mean? Steve Moore has the graphs that show over a calendar year the movement generalized of what the market will likely do any given time over that calendar year. I want both the long term and the intermediate term seasonal tendency to be moving in the same direction between one time of the year. It may begin at a specific month. It may begin halfway between the beginning and the end of a particular month. Okay. And now, just because we have a seasonal tendency there, that doesn't mean it's a green light go. Okay, it's Monday now. I've been waiting all weekend to trade. It doesn't mean to go out there and start doing something right away. You have to go in and anticipate price presenting these opportunities, and other things have to compound as a confirmation. What it is you're looking for is really there, and you're not just trying to force your will on it, because you can still fall victim to your own will if you force it. The idea of how all this stuff blends together, it's real hard to be anxious when you have a firm grasp on all these components. It doesn't mean that you're going to be 100% accurate. It doesn't mean you're going to be without a losing trade. It doesn't mean that you won't have drawdown in your trade. It just means that you won't be shaken out of your trade. And if you do get stopped out, it won't change your approach to using this information. So with seasonal tendencies aside, the next thing I look at is the economic calendar. Right now, I only have it set up for US, and these are the settings here. I don't usually look at the yellow, which is a low impact news driver. I don't care too much about that. I want the orange, which is medium impact, and then the high impact. Once you have that, then you can look at your full week here. So you can see on Monday today, we have nothing really in terms of forex factory. There are some events that you can see on Econo Day. Okay, Econo Day is another calendar that is more equities specific, and it's, to me, if you really want to be a perfectionist, that's the calendar you want to look at. But this is a calendar that's very easy on the eye. It's easy to manage. It's easy to see, the big triggers for when the markets will likely see some kind of excitement. Okay, and that excitement is what we call manipulation. Many times during the times of these reports, like tomorrow we have 8:30 a.m., the employment cost index, I don't ever consider the data. I could care less about these data points, because these are just excuses for them to, and when I say them, it's those individuals that are in control of the marketplace. So when we're looking at this timing aspect, I'm anticipating some measure of manipulation. Okay, so what I like to do, and this helps build, kind of like introduce the idea of narrative building here, I like to look at what price has done right before these scheduled time events where the economic calendar will produce the data and present it to the public. Okay, so there's smart money that has the advantage of knowing what these drivers are going to be like real time. And it's not to say that these events and the data that is released at the time and or the initial move that occurs at the time that the report comes out, it doesn't mean that that's the right move. It doesn't mean that that's the move that's going to be sustained and it's going to keep moving in that direction. Many times, and this is really what I'm looking for, I'm looking for these opportunities where I have a seasonal tendency in mind, that I have a long-term macro directional bias. Because if you can trade in that right there will filter a lot of your losing setups. So I like to look for those periods right before the time of the economic report coming out, that I anticipate that economic report being a Judas swing. A Judas swing is a fake run. It's a price run that's quick, it's sudden, it's explosive. It runs directly into a pool of liquidity. That means above a high or relatively equal highs for buy side, or it reaches up into a fair value gap, which would be in many instances a SIBI, a sell side imbalance, buy side inefficiency. So a down close inefficiency. Those are the two things I'm looking for if I'm bearish. Now, how do I know which one's going to happen? How do you know, ICT, which one it's going to do? Well, if there's no inefficiency, what's it going to do? It's going to run for the high or a group of highs. It could be 3 clustered highs in relative same price area. I'm going to pick the highest one. And I'm going to see, does it want to reach there? If it reaches towards it but falls short of the highest one of the relative equal, or if there's like 3 of them there, if it doesn't run the highest one and it starts to drop, I don't trust that drop. That's usually many times a trap where they'll then pump it one more time, run that one, take the higher high out. Then the break and structure after that, when it moves lower, then I'll be all over that like white on rice, selling short. But that's given I'm in a seasonal tendency that's bearish. Then I have a expectation that the market's going to introduce volatility, and that's what this calendar does. It tells us when we can sit back and relax. When I have a setup that is, I'm bearish, I'm in a seasonal tendency that's bearish, I have a market structure that's bearish, I have a market that is rallied up into a short-term premium, and I have a day when there's going to be a news driver that's going to be releasing with a high impact, which is always a red folder, or a medium impact, which is an orange folder. So I want to see a manipulative price run, which is a Judas swing, something against what I expect to occur. An example would be if I'm bearish, seasonal tendencies bearish, the longer intermediate term are agreeing in terms of Steve Moore's graphs, and that seasonal tendency is implying that we're likely to go lower. I want to see a news impact driver on a calendar like this that has a red or orange folder at that given time. Now, ideally, what I want to see is this. I want to see right before 8:30, I want to see it drop down below a short-term low first. Why? Because that triggers individuals on a breakout short, or knocks out the long holders that have a sell stop right below a recent low. I want to see that happen before the news driver hits. Then I want to see at 8:30, I want to see it rally up. So in plain terms, you're bearish. You want to see it drop right before the high impact or news event that's medium or high impact to take the stops that you think is going in the right direction, but you're not taking that trade. Now, all of a sudden, light bulbs are popping off. Why doesn't ICT trade this here as a break-in market structure? Why didn't he trade that? Why did he wait for? I'm telling you right now, you want to see the smallest little degree of movement dropping down to take out a short-term low. What that does, it trips traders short on a breakout because they think that news driver is going to make a big move and they want to get in. They're gambling. They place a sell stop to get short when it breaks out to the downside. You are waiting because you know that that's likely to happen. And when this does happen, and then you anticipate at 8:30 and minutes after that, it should be running north. It should be explosively running higher. That rips the face off of anyone that went short. Now what happens is traders are trapped going long because they're trying to buy the breakout above a recent high. They're trapped net long, and smart money goes in at that moment and sells into that rally because that's exactly what they're waiting for. You can go into model 2022, okay? Wait for a market structure shift again below the low that was right before the news event. When that low gets taken out, then you have a market structure shift. Oh, how do you know what low to pick that causes market structure shift? All these things have to be there because think about what the market's doing to what classification of trader. If you're anticipating lower prices and you're expecting some kind of manipulation to the upside initially, creating the high of the session or the high of the day, everything prior to that has to be used in concert with what you're anticipating. So these are the nuts and bolts on how I start the framework for a bias. If those things all agree and we're on like a Monday or Tuesday or Wednesday of the week, oh man, you can't understand how comfortable it is to trade in those environments because I have so many things in my favor. There's essentially 20 trading days in a calendar month. Generally, there's about 2 of them that I don't like to trade on, no matter what. That's non-farm payroll and the day before non-farm payroll. FOMC, I'm not afraid of FOMC. I'll trade on FOMC. The Mondays that I do like to trade are this week. Why? Because if you look at the economic calendar down here on Friday, what does that say? Non-farm payroll. So I know that even though there's no employment data, no economic data, no news drivers anything to speak of in terms of high impact or medium impact from forex factories calendar. There are things that are occurring today, but generally this is kind of like a light day. But we're also in earnings season. So all these things are going to create a wild week of trading. So I want to ring this in right now. When do I avoid daily bias? When do I avoid not forcing a bias on this event right here? We have FOMC this week. We have rate announcement. We have non-farm payroll. Look at this calendar. This is a minefield. So I don't expect myself to go in on a week like this and say, okay, I need to know what the daily bias is on Monday. I need to know what the daily bias is on Tuesday. I need to know what the daily bias is on Wednesday. I need to know what the daily bias is on Thursday or Friday. I don't. I give myself permission to not have to worry about that. So what does that mean? What do I do? Well, you have to come to the conclusion that you're either going to not trade or you're going to trade. If you're going to trade, how are you going to trade? You're going to trade without a bias. That means you're going to trade intraday volatility. With experience, and when you can determine when everything is in your favor for the market to be slated, bullish or bearish, and have a sustained price run higher or lower, those are the best conditions to trade in. So when I go into the charts, I go right to the dollar index first because I want to get a feel for risk on, risk off. If the dollar is likely to go higher, how do I know that? Well, we start with a monthly chart. If you can have 2 or 3 time frames visible at the same time, or if you have the luxury of having multiple monitors, you don't need it, but if you have the luxury of having that real estate, you can have a whole lot more insight by having more time frames in front of you. So what do we do and why are we looking at these time frames? What is it we're doing with them? Up here in the upper left-hand corner, that's a monthly chart. So this is the dollar index. I don't care what you trade. If you're not referring to the dollar, you're not doing effective analysis. When I look at the dollar index, what I'm looking for in a monthly chart is where are we at right now? Well, that's pretty obvious. It's right here. Where did we come from? Where did we just leave energetically? And how was it left? It's real crucial. And the things I'm talking about here, that's the same thing you're doing on a daily chart. It's the same thing you're doing on a 4-hour chart. It's the same thing you'll do on an hourly chart. The same thing on a 15, and same thing on a 5-minute, and same thing on a 1-minute, and the same thing on a 15-second chart. The price delivery continuum is how price is offered to us from a higher time frame perspective, like this monthly chart, down to those smaller time frames. Where are you at on that 15-second chart in respect to what we are doing on the monthly? How many times have you looked at the chart with that perspective? I may look at these charts on the monthly, the weekly, and a daily, and they have already done something, and now they're just sitting there where it can go either way. Then that I'm basically going to go in and trade intraday volatility. Then I'll look for these 10 to 15 handle runs in the NASDAQ and be content with that. Not try to reach for 50 handles, not reach for a 100 handle day, because the likelihood of that delivering is low. But here, if we're looking at the monthly on the Doppler, we have this up here. Now, we had a nice little run there, but now we have done what? We moved back into this inefficiency right there. We have traded to it and through it. This high right above that is going to have what? Buy side liquidity. To the left of it, we have this inefficiency right here. Below us, where did we come from? Well, we came from this low here. What did that do? Consequent encroachment. This wick. Wicks are gaps. Okay, that's how you should look at it. So whenever you see a wick like this and it created a turning point, a lot of folks will look at, if they're bearish, they're going to see that low as support. And if they're bearish, they want to see that support be what? Broken. I look at half of that wick and then the upper quadrant. Those are the most sensitive price points when you're bullish. If you did not write that down, you missed a golden opportunity of seeing something that repeats every single day. Intraday charts have this happening all the time. I want to learn how to trade candlestick patterns. Okay, well, this is one of the strongest ones, and that's not in your books. Now, these lows here, that was taken out. So that was a purge of sell side liquidity. Any drop down, we had this big long wick. I'm not thinking we're going to take that low out. Why? Why would I expect that not to be taken out? Because when it went down, it took out the sell side, but further to the left, what did it do? It rebalanced this inefficiency. It rebalanced there. Did it displace after doing so? Yes. Did it take out a short-term high? Yes. So any retracement down, if that wicks like that, your eye should be right there on the midpoint of it, which is consequent encroachment, or the upper quadrant of that wick, which would be essentially right around here. And look where the bodies of the candles are, right there on the upper quadrant. So if we open up a session in analysis and the market was trading down here, then I would be expecting reversal patterns to form on the daily, the weekly, the 4-hour chart. And then once I get some kind of confirmation there, then I can trust going into a hourly 15-minute, 5-minute chart and buy side and balance, sell side efficiency, fair value gaps, or buy down close candles after displacement. And then I have an order block. Oh, you missed it, didn't you? You didn't write that down. These are the parts you're supposed to be writing down. Those factors that are agreeing, it gives you bias. It helps you frame a narrative. Narrative, essentially, by definition, is understanding how the market will price an asset where it can do the maximum carnage for the express purposes of unseating potentially profitable speculators and then assuming their position and then quickly running in a direction that allows them to profit, but affords nobody really a state of mind till they can go right back in and feel like they're doing a thing by re-entering it. I can see what's going to be the reason or catalyst for them to lose or enter too early or on the wrong side of the marketplace. And when price delivers that very thing, that is the thing that gives me the green light that I can now take a trade because I've seen the manipulation. The manipulation is a timed event. You see it on the economic calendar. When there is no economic calendar event, then I heavily rely on macros. Macros are those 20-minute intervals, last 10 minutes of the hour that you're in, and then we start a new hour. It's the first 10 minutes. Every single trading hour is a macro. Hot damn! Did he just say that? Yes, I did. You awake? Well, they're boring you? You're awake now, aren't you? Holy shit, ICT's screaming again. Every single, remember I told you I could trade every single 30-minute and 60-minute candle? Because there is a macro. That 20-minute interval is there on every single hour. Now, the ones that cause intermediate terms in market structure changing and turning are the ones at like 9:50 to 10:10 a.m., 10:50 to 11:10 a.m. Then you have 1:50 to 2:10 p.m. and you have 2:50 to 3:10 p.m. They are the ones that you should study them first. What do you get when you have a news driver that is a 10 o'clock news event on a day where you have a seasonal tendency behind you and the market structure supposing that it moves in that same direction that the seasonal tendency implies, and you have a high impact news driver or a medium impact news driver at 10 o'clock? You think you're going to have a good move at that time? You're damn right you are. And if it's done maximum carnage by going higher, slightly higher, and then at 10 o'clock that news driver goes a little bit higher than all the highs it's been there, but you've been bearish. That's so beautiful, because I will take that as a turtle soup and I'll sell short. And then when it has a shift in market structure bearishly, I'm going to sell the first fair value gap that's bearish. I'm going to add on a breaker that's bearish. And I'm going to keep building every new pyramid entry I can that's an up close candle. As soon as it touches the low of that up close candle on the time frame I'm trading, I'm going to add another smaller position size and pyramid on it until I get to 60% of the range, okay, is still unrealized. That means 40% of the move has already happened. Then I stop pyramiding. I don't want to take any more pyramiding entries at 50% of the range I'm expected to see pan out on that trade. Why? Because I want to keep my last entry in my pyramided entry where I'm building these positions where I start with like 6 contracts, and then I'll do 4 contracts, and then I'll do 3, and I'll add 2, and then I'll add 1. I want that last one to be in the upper 40% of the range that is expected to be delivered to me as my profitable trade. There's rules to this stuff. Okay, so when we're looking for bias and trying to derive a bias, I start on the monthly chart and I want to see where we are. We're here. Where did we come from? We came from recently this low here. Why did it react there? What I just explained over here, taking out the sell side, we rebalanced this inefficiency. So really, what have we said here? We've completed every necessary thing for a discount. How do I determine the discount? How is that a discount? Here's one of those instances where you can copy. All right, so here is premium. This is the high it's been during all this drop down, and this is the lowest point it's been in. So this is your range for determining premium to discount. Equilibrium is midway. It trades up to it here. Notice it did that from high to low. It came right back up to midpoint. If you're bearish, equilibrium is premium. We are still in what area of price action relative to that range? Below equilibrium. So we are still, all of this is discount. We're in a discount market. Now, is it likely that the dollar is going to go higher or lower given this information? Well, that remains determining on what it is that we just left from. We went higher from this low, which was a reaction off of the consequent encroachment of this wick. When the wick went down there, it did 2 things. It disrupted the sell side stops here, and it rebalanced this. So pray tell, why does it need to go back down here? It doesn't. What has it not done? It hasn't made its way on a closing basis above equilibrium. And this high here, that liquidity is buy side. Right away, what this does is this tells me, because I've done qualitative analysis and quantitative analysis, I've based all of my premise on the fact that, what do I have here? I have a range from this high to that low, and we're inside that range. Is it more likely that we're going to go above this high or below this low right now? Well, if you were looking at in terms of the closest proximity, most people would say, well, it's probably going to go down below that low. I'm not thinking that. I'm thinking that we're staying in a discount right now for a larger, longer term price run higher. Here's the kicker. I do not need this high to be taken out. And I don't believe that this low needs to be retraded to, because we've had confirmation here. Consequent encroachment was offered and it displaced higher. We had sell side taken with that drop here, and it also rebalanced. That's every possible thing that would constitute a reason for the market to turn higher. So the work essentially has been done on the discount level, on this chart, on the monthly. Now we have to do the same thing on the weekly, the daily, and any time frame less than the daily chart that you use for your trades. So what I'm saying in plainest, simplest terms is we already went above this gap on that sell side imbalance buy side efficiency. We should have been looking for it to drop here if this was going to continue going lower. And it didn't. It just kept going higher. You have mean threshold of this down close candle, which is a bullish order block. It trades to it here. Did it react higher? Yes, it did. It went above this inefficiency here. So what is left on the upside, or in a premium perspective? This high and this inefficiency in here. So confluence of this high having buy stops and inside this inefficiency, and if we split that in half and get the consequent encroachment or midpoint of that gap, this 50% is equilibrium on that range from the highest high and the low that we were just talking about. And right in here, this little shaded area has buy side and up to the midpoint of this sell side imbalance buy side inefficiency. So where we are right now, we're in a discount. Where have we come from? A deeper discount, a rebalancing, sell side been taken. We had confirmation given to us here with the consequent encroachment of that wick. We displaced higher and we broke through what would normally be expected to see what? Hit in here and go lower. It hasn't done that. So the untapped opportunity is buy side hasn't been taken in that range, and the inefficiency over here, and we haven't gone above equilibrium on a closing basis. So there's 3 factors right there just on the monthly chart that tells me higher dollar eventually. So here we have the weekly chart, and the same thing here now. We look at what it is that is likely to occur. Inside that little blue box, that's the draw on liquidity for ICT. I believe that that's where the dollar index can draw to. But now when we entered into the weekly chart, we have new imbalances, short-term buy side, relative equal highs. It does not change this. It confirms, in my opinion, it qualifies it more as a likely draw on liquidity. We have this inefficiency right there. It went down into that buy side imbalance, sell side inefficiency, and it touched exactly on its consequent encroachment. Did it react there? Yes. Then we opened, traded down. We can have initial, because it's Monday, we could see it drop down and close in this inefficiency. Personally, I'd like to see some of this left open. Why? We've already came down and traded into an order block. That's this one here. With a fair value gap, it dropped down once, twice into the fair value gap that's formed and touched the order block, the last down close candle. Within the context I've outlined it. That's why this is a down close candle that we can call order block. The down close candle in this instance here, that constitutes and makes that a valid order block. The opening price of this candle right there, that is the change in the state of delivery of price. That is the very trigger. That's the catalyst. It's not this range. That's not a zone. I'm not looking at a zone. It rallied up into this high. There's a lot of order flow that's going. And remember, this is a weekly chart. We've had this inefficiency traded to and displacement to the upside. Now we have this inefficiency here. And we traded down to it here, there. And now we want to see price ideally leave this open. But because all of the news events that's due out this week, what can we allow for in our analysis? Are we going to demand that it stays open and be hardlined about it and dogmatic? It has to stay open because ICT said so. No. I would prefer that it stay open and not completely come all the way back down and touch this candle's high. I'd prefer that it doesn't do that. Because if it does that and remains open here, that this swing low on the weekly chart can be trusted, and it's probably going to move, if not this entire week, going into next week, up into here to draw to that buy side. Because these stops here, they made money, but they're squeezing on them. And because there's no inefficiency in here now, in this range, what is there? It's the focus on the stops. And those stops also reside in a monthly inefficiency over here that doesn't look all that inefficient until we get over here. Short-term draw on liquidity is here. Intermediate-term draw is here. Now, with that, we can drop down to the daily chart. Man, we finally made our way down to it. Now we have this inefficiency. Look how many times we've been in here. Once. See, we're there. Lower, 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 all the way down into here. Notice that we completely went outside the range of this buy side imbalance, sell side inefficiency. But it was only on the basis of what? The wick. What did I teach you? The wicks do the damage. The bodies tell you the story or the narrative. The bodies are stopping inside of that inefficiency. See that? Yeah, we went down to that level, but that's the weekly chart's fair value gap's consequent encroachment. It's the midpoint of the weekly. So the price delivery continuum, moving from the higher time frame down the lower time frame, we're teaching you how to effectively look at it algorithmically from the top down using inefficiency and or order block. It's one or the other. The turning points are going to be liquidity based or inefficiency based. Entries are always formed on the basis of inefficiencies being retraded to or order blocks being repriced to. If you don't have that written down, you missed it. So the bodies are telling us what? We have done what we need to do. Yeah, we went lower, but don't be scared now. Don't be afraid. Even here on this candle here, on this daily candlestick, we went just a little bit outside of the range that frames that fair value gap. I expect it in certain instances to color outside the line. How do I know when it's likely to do that? Because I went on a higher time frame, like we just had on that weekly chart. That's this inefficiency, and it only went down to halfway point of it. But this dropping down in the lower time frames, that is absolutely permissible because of the higher time frame inefficiency. Now, how far can it trade down? It could have ultimately traded all the way down to here on a wick. Why? Because it's a weekly chart inefficiency. That's the low of the inefficiency on the weekly chart, and the high was that level, and the midpoint of it's here. That's why it went down there. But now, because we have had multiple instances of this, and we have one more pass here, and it didn't go below that low on this one here, where I would have demanded it had done that. If we can keep this candlestick from closing below here, everything I'm talking about, I'm still sticking with a bullish dollar. That means risk off. So that right there is the 85 to 90% framework of how I determine daily bias. Now, how do we segue from the daily bias to a session bias? The market has moved from this high down to that low. So we have a range. I'm picking this candlestick high because it's the up close candle and it's the highest high and that low. Okay. We are essentially above equilibrium. We've closed it there. So we're above equilibrium on Friday. And then we have today. We're sitting around in an indecisive day, which is classic for what the economic calendar shows us. To the left of that, we have this right here. So this sell side imbalance, buy side inefficiency, that is the premium draw. If the dollar drops down a little bit, it could send us into this fair value gap. So you want to have this level, and you also want to have the consequent encroachment and quadrant levels on that inefficiency. I am expecting it to trade to the lower quadrant, and as much as the halfway point or consequent encroachment of this inefficiency. That is my Monday, Tuesday, Wednesday bias. That's all I'm holding for in terms of what it can do. Now, with that said, if it can go beyond this midpoint on a closing basis, but doesn't go up here yet, then I'll anticipate the market resuming when it opens at 6 o'clock later in the evening time. I might take an Asian session trade to try to reach up in and get that inefficiency closed in. Or if it consolidates and drops back down to the low of that inefficiency during Asia tonight, going into London in the morning between 2 o'clock and 5 o'clock in the morning Eastern time, I might take a long if it did what I'm explaining and then try to get a run up to get that closure there. Or tomorrow's New York session, I might be interested in seeing that trade there. You see how everything moves from, if it does this, then I will do that. If it does this, but not that, then I have to sit on my hands and wait. Much like I just outlined with the dollar index, we can see the framework here. We have the market turn here. We rallied up. We had a single down close candle. It traded into this down close candle on the daily chart. That opening price is the very price that causes the change in the state of delivery. What that means is it will now change its directive to now seek premium inefficiency or buy side or a combination of both. I'm looking at the opening price. If it's a down close candle or an up close candle, that is the very trigger. That's the mechanism. That's the price. That is the salient point. That's the bullet point. That's the factor that you're looking at. That's the very thing. That's the key crucial point of information. That opening price. That is going to tell me everything I need to know in terms of where the market's going to reach for, how it's going to deliver, the speed, the magnitude, is it going to continue, and where that order block is in market structure is going to tell me if it's going to be a target, if it's going to be an initial entry, if it's going to be a factor for where my stop loss should be placed above or below, respectively. But that opening price, that is the change in the state of delivery, meaning that now, because what we were doing was we were going lower, seeking a discount. When we went above it, when the narrative suggested that we could potentially turn and go higher, the technical aspects to it is that down close candle and its opening price. That price is like a trampoline. When price is above it and Trump trades back down into it, it'll create, if it's good, it will create feedback in price delivery, where I call that a signature. If price on the lower time frames are supporting, or it rallies away from it and then creates a fair value gap above it, I'll take that as a fair value gap entry and go long if it's a scalp and get 10, 15 handles, 20 handles if I can, and be done. And that's trading without a bias. But the market traded down here into that candlestick right there. Same thing. The down close candle. Where are we at in respect to the range from here to here? We're still in the discount. Here's the equilibrium price point. So this down close candle is absolutely crucial information for you taking trades. But this is a daily chart. So you have to allow for coloring outside the lines if you're using lower time frames. So we have two down close candles here. You have bullish order block in the lower portion of the range, the lower half. Once we get into real close to that equilibrium price point, order blocks can become 50-50. And it really demands your understanding of why you think it should go higher anyway. So we're going to look at a 4 hour. All right, so here we have a 4 hour chart, and here are our respective daily order block levels. In a protracted price run, that means where it's continuously moving in one direction, higher or lower. In an up move, ideally, you only want to see a few down close candles because that tells you there's a lot of strength in this up move. If you see a lot of down close candles forming, that means either you're at the consolidation midpoint of halfway of that move, or you're probably near the high. In the next run it goes up, it's going to be that's the end of it and it's going to collapse. And that right there, if you didn't write that down, you missed the whole thing today. Because down close candles in a up move, they should only be there for new opportunities to buy, period. If you start seeing a whole lot of them, the more down close candles you see in the time frame that you're trading when you're bullish, the more likely you're at either consolidation, and that's good news if you have a higher time frame objective or target where you think the market's going to draw to. If you start seeing a number of down close candles starting to form around in the general proximity of where you're at in price action, you're usually at a consolidation point. That means you're at basically a midpoint of the next price leg will repeat what you just experienced. So it's like a measured move type thing. Think of it like a classic bull flag, okay, where that pause, that little consolidation is just the midpoint of the overall larger move. And a measured move is just a replication of the first leg up now will be repeated, but many times it's done so in 3/4 or half the time. So all these down close candles and up close candles or order blocks, they give you intel, not just a entry or a target or a means of managing your stop loss, but it also gives you insight in determining the strength and the underlying probability of the continuation of that price leg or run that you're part of. Ideally, you don't want to see a lot of down close candles. But when you do see them and it does return back to them, you want immediate respect. If you don't get immediate respect, the same thing holds true. You probably are at a turning point, and any rally that comes off of that, the next candle or the next candle after that, within 2 candles of hitting that order block, if you don't get the responsiveness, or if it comes off of it just really lackluster, you're probably only trading up to a short-term premium, which would be model 2022 or a breaker, and then that's it. It's over, and then they're going to pull the rug and it goes lower. Let me go back to the daily. Here's the framework. Here's that last down close candle. So when we look at 17,530.75, and when we look at this price level at 17,682 even, that's these two respective order blocks. They're order blocks because they're in a lower portion or in a discount relative to the range that you're using to qualify the down close candles to be a bullish order block. And because it's a higher time frame daily chart, they have a lot of influence over price. They're going to be very influential. So having them on your chart and drawing them out like this, what price are we looking at? Well, it's inside the zone. Wrong. It's the opening price. That is the change in the state of delivery. That means that the market will now seek buy side premium arrays or liquidity. That means buy side or buy stops. One of the two or a combination of both. But this is a daily chart. We're going to go into these lower time frames. We'll drop down to a 4-hour. Okay, and I want to take your attention into this right here. Everything's the same that we did on the monthly. Everything's the same on the weekly. Everything's the same on the daily chart. So we'll drop down into a 60-minute chart, which is hourly. All right. If you look inside here, we had this candle run above the order block. That's the lowest one on the daily chart. The next candle we drop down. What does it do? It does an immediate rebalance. Now, if you've never heard me teach on this, an immediate rebalance is where the market has a nice big bullish run candle higher or a bearish candle that has a large range that moves lower. And the immediate next candle after that reprices to the previous candle to that big candle that just formed. In visual terms, it's this. Market rallied here. This candle went above the order block. That's that opening price on the daily chart, that big blue line there. When we went above it, the next candle we traded right back down. And what did it do? It went right back to the body or high of the previous candle right before that big candle. So when it does that, what I'm watching is it either will start its run in the direction I'm looking for, which is in this case would be higher, either that candle or the very next candle. If the next candle does not run and it takes out that low, I am no longer interested in taking it along. I have to move to the sidelines. Immediate rebalance is one of the strongest things I have in my repertoire. It will basically be like, say this candle only stopped with its low right there and didn't go as low as it did there. And it closed and it opened over here. What would it have formed? A fair value gap. But because the market is in such a rush to get somewhere where this would have been an obvious fair value gap, I'm watching this candle live. I'm watching whatever time frame I'm watching the trade on. I'm looking at how price behaves like this. And when it creates this big run like this and we open up here, I'm waiting to see, does it create a fair value gap? But when it trades down to the high or the body of that candle like it does here, in my mind, if I'm bullish, that's exactly what I want to see happen. And if I can't get in on that candle, as soon as the next candle opens, I'm buying it at the market. Immediately, I want to just be in it. Why? Because it's going to perform just like this. If I'm right and everything is equal and I'm on side, that's exactly how the market should behave. The market's going to reprice at that price point and immediately run. And it has nothing to do with this order block. That's just one more qualifying thing for it. It has nothing to do with this breaker right there that's bullish. Low, high, lower, low. Take that range, extend it over here. That's another trade entry. I'm talking about what I'm seeing in price. That candle, when it opens and trades right back down to that candle's high, I'm in it. If I can get in there, I'm in it. Where would your stop loss be, ICT? Low of that candle, or at least the mean threshold of that candlestick's body. That would be this. Watch. That's midpoint or mean threshold. My stop loss has to be below that. In honesty, it would be really at that opening price. But the logic is, if we get a big run candle in a direction that we're looking for, the very next candle, I'm waiting to see a fair value gap form. But if we're lucky and fortunate enough for it to come right back down to it there, man, we are in a loaded deal. It's the loaded deal. Why? Where is it forming? What's this blue level? That's that daily order block. It's opening price. So you need to be looking at that level in a lower time frame. And we're only on an hourly chart. But the magic happens when you start applying all these things together that flesh out a narrative. Over here, what's this blue line? That's that higher daily order block, the opening price, because that's the change in the state of delivery. What does that mean when ICT says it's the change in the state of delivery? Prior to that candlestick forming, the market was going a direction. It was going lower. Because of that, when we have a turn, you don't need to know when it turns. It can stop you out of shorts and prove to you that it doesn't want to go any lower. Then you start measuring what I've showed you here on the daily chart. But if you want to use it to probe any long positions, or if you're confident and convictions are strong enough, you want to be a buyer and hold for longer positions higher, you can key off those daily levels like this. But in short, what's happening is if you have an order block opening price, whether it be a bearish or bullish candle, you need to have those levels transposed to your lower time frames, because you're missing trades and you're missing many times the best of the best. Now, what happens if you can't get in on this move? Then you have to enter inside this range here, and you may or may not get an opportunity to do so. It just might happen that you don't get an instance where it can come back down and trade below a 1 minute swing low for sell side. It may not have a fair value gap that it trades down into. It may not give you a 1 minute or sub 1 minute bullish breaker. All those things can form inside this. That's why I taught every PD array that I was willing to share, because they all can be used to get into a move that's already started without you. And it will not technically be chasing, because really what you're doing is you're keying off of what a high frequency trading algorithm is going to do anyway. So let's look at this little piece of action in here. We're on an hourly chart here. So when it dropped down, it touched that higher bullish order block, the opening price. So it's going to act like what? A trampoline. It's going to spring. It's a change in a state of delivery. Delivery is directional price run. That's what that is. So if there's a change in a state of delivery, that means what we're saying is there's going to be a change in the direction of price. So if it was dropping, when it went down into this level here, went lower, lower, and then we rounded above it, this candle, the first return back into it there, what is it coupled with? It's coupled with an immediate rebalance. It's a bullish breaker with this candle here. That is your order block. That is all occurring at your daily opening price, which is this change in the state of delivery. That means what's occurring? The algorithm that you don't believe exists is now going to spool price higher. But this rally, when it runs, what is it reaching for? If there's a change in the state of delivery, it's going to seek the opposing side of what? Liquidity or inefficiency. That occurs right here. To the left, what do we see? Well, we have this little inefficiency here, but it's short order to do that. We don't need it just to trade here. We need it to show us a run. Right in this price fractal that I'm showing right now, where's it reaching for if it wants to go to buy side? Relative equal highs right here. And what? That high. Now, the same thing we apply to this opening price on the higher daily order block. What's occurring here? The market creates a consolidation, and it needs to do what? It drops down into a short-term discount. What does it trade to? The order block's opening price. When it does that, it's going to act like a trampoline, meaning what? It's going to go down to it, press into it, and spring higher. By itself, it is not useful. You need to see other things confirm it. That's what makes it an order block. If it's just a down closed candle, that means absolutely nothing. The price action signatures that you're looking for is a confluence of other factors that would support the idea that it needs to be responsive at that price point, at that time. What else is occurring right here when it drops down and hits that order block's opening price? What's it reacting off of? What is this? Well, if we measure that, what are we looking for? The best buys are going to be at what? Midpoint or consequent encroachment in the upper quadrant. Where's the bodies at? Forgot about that, didn't you? The bodies are telling you, they're telegraphing you that we're going higher, but we got to damage some people first. This needs to stay open ideally. That needs to stay open. The best buys are going to happen in the upper quadrant. What looks like a premium to you, but it's not. That's the ideal entry because you're already in a discount. We don't want that lower portion to be closed in or overlapped on. We don't want that because what that indicates is it's exceedingly bullish. This will act as a breakaway gap. If we get to a consolidation place in the price run and it creates a gap like this where we want to leave a small portion open, that is a measuring gap. But the fact that it has to be part of a larger consolidation or one leg of the price run's already occurred and then we're consolidating and then we get another gap where it creates an environment like I'm explaining here. If it stays open, that to me is going to be a measuring gap. That means it qualifies that we have another price leg that's going to be equal to the initial move or maybe even more, but it's going to do it in 3/4 of the time that it took to make the first leg or less. So what does that mean? Many times that's your second stage reaccumulation in a market maker buy or a second stage redistribution in a market maker sell model. Hot damn! Did he just give some gold? Yes, I did. And for free, you're welcome. But let's dig into a little bit more detail right down here. This is an hourly chart. That's our higher time frame bullish order block, opening price. It's the change in the state of delivery. That means what was it doing? It was just dropping down. We're going to anticipate what? That trampoline, that springboard effect off of that level. We have to have something else. We already have it on the same time frame, which is consequent encroachment of this buy side and balance sell side inefficiency. Why? Why should you have that rule? Because ICT teaches that you don't want to see every imbalance completely closed in. That's what gives you the narrative. If it's always able to come back down and fill in every single buy side and balance sell side inefficiency, we're probably near the end of the price run. Think. They don't have any time to waste. If they're going to come down here, that means it's going to be a lethargic price run. I don't want to be a part of that kind of stuff. But hourly chart, we're going to drop down to a 15-minute time frame. We're focusing primarily right in here. Okay. We already have one qualifying thing, which is the consequent encroachment of that buy side and balance sell side inefficiency. It should leave this portion open down here. You want to see that lower portion not filled in. The more times you see that, man, that is telling you it's going higher. It needs to go somewhere higher. That's what it's indicating to you. You can't get a better visual representation of confirming and qualifying a setup than that. That is the signature that I'm looking for. If I'm trading a bull flag, a bullish order block, I want the lower portion of that candlestick not to even be traded to. It can touch the mean threshold halfway point, but if it does that, it needs to immediately kick off and start running. If I'm trading a fair value gap, and I'm bullish, I want the upper portion to be responsive. I don't want to see it dilly-dallying around at all in that lower half. I don't want to see that. If I start seeing that, as soon as I see any momentum waning after it starts to run, I'm scaling something out. I'm more inclined to start taking partial. So we're going to drop down the 15-minute time frame. Again, we're looking right at this price level right there. Same thing in here. We're looking at relative equal lows. So there's a sell side liquidity pool being engineered there. Look what they do. They run first higher. So what does that do? It triggers longs. Why would they want that? Because if they're going to go long, they're going to put what? Sell stops. Where are they going to put them at? Below the relative equal lows. Well, then that's convenient because right down here is that order block. And right down in here is that consequent encroachment of the 1 hour buy side and balance sell side inefficiency. So now we have liquidity engineered right at a buy side and balance sell side inefficiencies consequent encroachment or midpoint of that gap. Is that 3? That's 3. That's 3 things. We have inefficiency being factored in and liquidity now. So when it hits this price level, what should it do, ICT? Springboard higher. Does it do so? Absolutely. So I've taught you how to look at order blocks, how to qualify them. They got to be in a discount or a premium. The higher time frame ones, you need to transpose those levels to the lower time frame. And when you go into the lower time frame, you want them to be in agreement with at least 3 PD arrays, 3 more things to justify it. The level of a order block's opening price or mean threshold is in and of itself, by itself, useless. They are the markers in which you go into price and you study around that. And if you have 3 PD arrays, 3 reasons, whether it be liquidity or specific price levels that is a PD array. Liquidity is always a PD array, and it's dynamic. It can be in any time frame, any level of premium or discount. But when it's coupled with a level that is expected to promote higher prices, it's a slam dunk. Like, it's a slam dunk. There's nothing to consider about it. It's easy. It's just waiting for you to get in it. If you don't get in it, just take the next one, because they're going to repeat every week, every day, and it won't stop. So here's what it looks like on the 15-minute chart. We'll just drop down for shits and giggles on the 5-minute chart. Last down close candle, displacement to the upside. Did we trade to consequent encroachment of that buy side imbalance, sell side efficiency, and the upper opening price on the daily bullish order block, that level here? Yes. Did we see displacement? This candle? Yes. Last down close candle. What is the change in the state of delivery? What price is it? It's the opening price. Price comes down, trades to the low of that candle. Did it respond? And then what do we have here? You missed this down here. You weren't able to dial in. No problem. We're on a 5-minute chart. We're in a 5-minute chart. We're still below equilibrium. So we're in what? We're in a discount. So can we take a fair value gap entry? Absolutely. But right in here, where's the best entry, ICT? Listen, this candle right there, okay? You want your entry to be in the upper portion, that price level or higher. You can save yourself a lot of heartache by just simply going in one tick below the high of it. Your risk is the low that creates the fair value gap candle. So if you look at this right here, that gives you your framework. What was the midpoint here, or consequent encroachment? 17,770.25. It trades down and offers that price level plus its tick. I never, listen to me, folks, this is a constant. I never use the consequent encroachment level as a limit order. I never do that. There was times when I tried to do that because I wanted to be really, really in there at the lowest low. I missed some really good trades, some phenomenal trades, like huge, huge runs, because I demanded that much precision. There's a balancing act here that you're going to have to manage, okay? The upper portion of an order block from its midpoint to its high, every fair value gap from its midpoint to its high, if you're buying, that's your ideal entry.